Amid all of this crazy in AI stock investments, especially in the US, there's one stock that I feel has been overlooked in terms of its AI technology, and that's Alibaba. So, in this video, I wanted to elaborate on the several different ways Alibaba is capitalizing on the increasing effectiveness of AI, and combined with the ridiculously cheap valuation of Alibaba stock for investors to consider Alibaba as one of the AI stocks to have on your watch list. So let's take a look here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Right, so Alibaba is saying that revenue from AI related products maintained triple digit growth for the fifth consecutive quarter. This is Nvidia like numbers, right? Nvidia has grown revenue triple digits for several consecutive quarters. And Alibaba, not for the entire business, just for its AI related business, because it has other business categories that are growing much slower. But just its AI business is growing triple digits for five consecutive quarters, and it's increasing market share. So it's not just the US that's feeling this AI boom. The AI boom is taking hold in China as well, and Alibaba is benefiting from that trend. So they believe the AI era is just beginning and we're just in the early stages. And this is what I've been discussing about the US and its AI development, how it's still in the early stages of development. And the reason I highlight this is because a lot of investors are growing concerned that AI related investments have jumped by too much too quickly, and there's going to be a sharp reversal. Now, that might happen. There's always a chance that might happen. But all the forecasts and all the data I'm reading from all of the various, I follow over 100 companies, and everything I'm hearing from those companies and macroeconomic data suggests that there will be continued investments in artificial intelligence for at least another 5 years and perhaps another decade or more. And the fundamental reasoning for it is because it's just so much more cost effective, so much more cost effective in the innovation it provides, and also in the reduction of cost of existing technology. So, not just in the new technology it can enhance, but the existing technology can be delivered at a lower cost. And so, it's a no brainer for many of these businesses to invest in their AI capabilities because of the advantages it provides. They're not just investing in artificial intelligence because of the hype or because of the investor enthusiasm it will generate. Though it does generate investor enthusiasm, but not uncontrolled enthusiasm. Investors are not just giving companies the benefit of making AI investments. You've heard companies like Microsoft and Amazon and Alphabet and Meta platforms come under pressure because they're spending tens of billions of dollars on AI. And investors haven't just said, oh, wonderful, and cheered on the news. They've taken a skeptical approach and said, why are you investing so much? What are you getting in return? Are you concerned that you're not going to get a sufficient return on investment? So investors have been questioning these companies for investing in AI. They're not just giving them a thumbs up and saying, kudos for making the investment. We're going to give your stock an increase in purchases. So this investment in AI has been a more prudent approach than I've seen in other categories. You've probably heard me make the opposite case for the investments in electric vehicles, how that was not driven by fundamentals, how that was driven a lot by hype and enthusiasm. And any company that so much as presented a picture of an electric vehicle in 2020 and 2021 received millions, if not hundreds of millions, if not billions of dollars in investments. And so that investment boom was more so driven by enthusiasm and hype, whereas the AI investment boom is driven more by the fundamental factors that improve a company's operations. And so Alibaba saying that AI's potential extends beyond the mobile screens. It's poised to reshape the digital world and ultimately transform industries in the physical world. We will continue to invest in advanced technology and AI infrastructure while optimizing operational efficiency. And this is similar to what I've shared with you from companies like Microsoft, Amazon, Meta Platforms, and Alphabet. They've all said a similar thing as this sentence here from Alibaba, that they will continue to invest in AI because they're seeing a great return on investment. And so they're going to keep investing. Alibaba, it's sometimes known as the Amazon of China. It offers similar businesses. It has e-commerce and cloud services just like Amazon. And it's making similar investments in AI because they're seeing similar things to what Amazon is seeing. And the benefits outweigh the cost of making these investments. So again, they say that their cloud business maintained rapid growth in AI related products. And they continue to explore the application of AI across their business. They launched and updated multiple AI tools. And again, similar to some of the large cloud providers in the US, they're not only harnessing artificial intelligence for resale to other cloud businesses that purchase their cloud services, but also internally. How can we use these AI capabilities to improve our services? How can we improve our e-commerce business? How can we improve the searchability? How can we improve our recommender systems? And how can we perform all of these at a lower cost of computing? And they're seeing similar results as I've seen from other companies that operate in similar services. So their new AI-powered platform-wide marketing tool saw an increase in merchant adoption, and merchants benefit through improved marketing efficiency, which of course will lead to increased spending on the platform. If you're a merchant or if you're a small business, let's say, and you're spending $100 on marketing on the platform, and you notice that using artificial intelligence, your marketing investments are more effective, you're getting a better return on that investment, you're seeing more customers come to your website and buy more of your products, you're going to say, wow, this is good. Maybe I should increase my budget from $100 up to $200 because when I'm spending 100, I'm getting 100 and let's say $25 in return in benefits. Well, what will happen if I increase my spending to 200? Will it increase to $250? And if it does, then you'll say to yourself, well, what if I increase my budget to 300? So long as the return on investment is sufficient to make that investment, marketers and small businesses will likely continue increasing their spending because they see the results. They see that it's bringing back sales and bringing back profits. And so they'll keep reinvesting in that category. It's hard to find areas where, as a small business, you can spend dollars and get back a good return on investment. And so when you find that area, you usually lean into it as much as possible to maximize it, to make sure that you're getting the most benefit you can get from that category. And that was the case here with this marketing tool. And it's still in the early stages. So you're going to see more and more businesses increase their spending in this category until they find that new optimal level, which is likely higher than where the previous level was because of the improvements from AI marketing, from using artificial intelligence for better targeting of investments. So even after this boom in Alibaba's stock price, remember the company benefiting from the announcement of fiscal stimulus in China, that's sending the stock price higher by as much as 10% as of this recording today. But even after that increase, Alibaba stock is still cheap. It's trading at a forward price to earnings of 9.6. So I don't think it's too late for investors that are interested in this company. Remember, there is a reason why it's trading so cheaply compared to its e-commerce peers like Amazon, which is trading at more than 3 times this valuation. And it's because of the geopolitical risk. Investing in Chinese stocks are inherently more risky than investing in US stocks because of the government's relationships with business in that region are not as robust as in the US, where the government typically doesn't regulate or doesn't crack down on business as much as you've seen happen in China. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.